The Federal Reserve recently announced its decision to keep interest rates unchanged, maintaining the federal funds target range at 4.25% to 4.5%. For most people, this might sound like just another piece of economic news, but beneath the headlines lies a reality that directly affects your financial life. In this video, we'll explore what this decision means for regular people in the United States, and more importantly, how you can protect and grow your money in this environment. But first, let's get some basics out of the way. The Federal Reserve, commonly known as the Fed, is the central bank of the United States, and one of its main responsibilities is to set interest rates. By keeping rates steady instead of lowering them, the Fed is signaling caution. Why? Because in the first quarter of President Trump's term, the economy declined to 0.3%. In contrast, the economy expanded by 2.3% in the fourth quarter of 2024 and maintained an annual growth rate of 2.8% for the year. Also, there are significant risks of inflation, rising prices for everyday goods, and concerns about job stability. Essentially, the Fed wants to avoid making money too cheap to borrow, which can fuel inflation. Now let's talk about how this decision will affect regular people. The Fed's decision translates into several concrete financial realities. First, borrowing costs will stay high. Buying a home with a mortgage remains costly. Adjustable rate mortgages, or ARMs, may not see relief anytime soon. Also, variable rate credit cards won't become cheaper, so carrying a balance can quickly become expensive. And lastly, new personal loans are also likely to come with higher interest rates. Second, on the flip side, savings accounts and CDs aren't offering much in terms of returns. Even as banks keep lending rates high, they are slow to raise the interest they pay you on your deposits. This makes it challenging for savers to grow their money without taking on more risk. Third, higher interest rates often mean a cautious stock market. As borrowing costs for companies rise, their profitability may take a hit. Investors become cautious, and market volatility can increase. For those with retirement accounts, this may mean more ups and downs. Fourth, without a rate cut, inflation may remain a persistent issue. Groceries, gas, utilities, and other everyday expenses could continue to rise in price, especially with the tariff uncertainty from the Trump administration. This squeezes household budgets, especially for those who aren't seeing wage increases. And fifth, higher rates can slow down business expansion, as borrowing for companies also becomes expensive. This could mean fewer job openings, slower wage growth, or even layoffs in certain industries. Before we continue, if this video is helping you out, go ahead and hit the like button. It lets YouTube know this is worth sharing. And if you want more simple, no-fluff financial advice, make sure to subscribe and turn on notifications. Thanks. Now let's go back to the video. Understanding the impact is just the first step. Now let's talk about what you can actually do to navigate this financial environment. First, if you have high interest debt like credit card balances, make it a priority to pay those off and avoid taking on new variable rate loans. Stick to fixed rate options to protect against future rate hikes. Second, shop around for high yield savings accounts or CDs to get the best interest rate you can. Also consider Treasury inflation protected securities, IPS, or bonds if you are worried about inflation eating away your savings. Third, adjust your budget to account for higher prices. Groceries, gas, and utilities may not get cheaper soon. Also, use cashback apps, look for discounts, and avoid impulse purchases. Fourth, diversify your portfolio. A mix of stocks, bonds, and even some inflation-protected assets can help. Fifth, if you're looking to buy a home, consider saving for a larger down payment to reduce your mortgage costs. If you're renting, evaluate whether continuing to rent is more cost-effective in your area. Sixth, given economic uncertainty, having 6 to 12 months of living expenses saved is crucial. If you don't have this, focus on building it up as a top priority. 7. Consider upgrading your skills with online courses, certifications, or other training. Now more than ever, develop your professional network to stay informed about new opportunities. The Federal Reserve's decision to keep interest rates steady is a clear message. They are walking a tightrope between inflation and economic stability. For regular people, this means navigating a world where borrowing is expensive, savings grow slowly, and the cost of living remains high. But you don't have to be a victim of economic forces. By understanding how this decision affects you and taking practical steps to protect your money, you can not only survive but thrive, even in a challenging financial environment. But tell me, do you think keeping the same rates is a good idea? If you found this video helpful, make sure to hit the like button. It really helps the channel grow. And if you want more clear, no-nonsense financial advice, don't forget to subscribe and ring that bell so you never miss a new video.